Taiwan just posted the best January in its history. Yet the Minister of Economic Affairs spent the same week explaining how the country plans to keep lights on through April. Those two facts aren't separate stories. They're the same story. Export orders hit a record of 76.91 billion US dollars in January. That's the first time they've ever cracked 70 billion in what is considered a slow season. Information and communications products, ICT, think AI servers, cloud infrastructure, the hardware the world's digital economy runs on, posted order growth of 102% year on year. That's doubling last year's amount, the largest increase in nearly 40 years. Industrial production hit a January record, and the labor pension funds posted a record as well, 12.57 billion US dollars in gains in a single month, smashing the previous record by nearly a third. And 3 days into March, somehow the Minister of Economic Affairs was in the legislature fielding questions about coal-fired backup generators and whether April's gas supply would hold. Let's get to the bottom of that this week. Hi, you're listening to Beyond the Reefs, a show produced by Radio Taiwan International. Here we talk about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.
Markets in Taiwan and across Asia bounced back Thursday after steep falls earlier this week, driven by fears over how the war in Iran will affect energy prices. Taiwan's TAIEX closed up more than 2%, though still about 5% lower than last Thursday, the last close before the war began. That trend was seen across Asia. South Korea's Kospi closed up more than 9% after a 12% single-day fall this week, its worst ever daily drop. Taiwan's cabinet says despite the war, the economy has been relatively stable. The cabinet has also extended tax relief on key raw materials and activated an energy response team to secure alternative supply routes.
Taiwan's exporters started the year off strong, with orders setting a new monthly record in January on the back of strong demand for AI. The Economy Ministry says January orders rose over 60% from the previous year to a record 76 billion US dollars, marking its 12th straight monthly gain. Orders for telecoms products were up 102% from a year earlier, while those for electronic products rose 79%. The ministry expects a 12% rise in export orders from last month, citing the Lunar New Year holiday and geopolitical factors. It says uncertainty over global trade policy and other risks could affect momentum.
Taiwan's export orders reached 76.91 billion US dollars, and it isn't just a number, it's a threshold. January is, by definition, a slow month. Lunar New Year compresses the working calendar and factories run at low capacity. Buyers hold off on large commitments, and the fact that orders still broke 70 billion US dollars for the first time ever in that month tells you something about the structural demand underneath this seasonal noise. The ICT figure is the one that stops people cold. A 102% year-on-year increase in order for information and communications product. That's servers, AI infrastructure, that's the physical hardware that every major tech company on this earth is currently racing to acquire. The last time ICT orders grew at anywhere near that pace was nearly 40 years ago. Electronic product orders hit a January record of 32.59 billion US dollars, up 78.6% year on year. Even industrial industries, like base metal, machinery, chemicals, posted gains between 9 and 40%. Industrial production told the same story. The manufacturing index rose 28.51% from a year earlier to 124.51%, marking the 23rd consecutive month of year-on-year growth. Computer, electronics, and optical products surged 139%, its 31st consecutive month of growth and the largest increase for any January on record. That was a lot of numbers, but generally, I think the takeaway is that things are on the up and up, And even the labor funds. The Bureau of Labor Funds manages 5 separate pension and insurance pools here in Taiwan: the Labor Pension Fund, the Labor Retirement Fund, the Labor Insurance Fund, and the Employment Insurance Fund. And the Arrear Wage Payment Fund combined, they're worth about 252.5 billion US dollars. In January alone, they posted 12.51 billion US dollars in gains. The previous monthly record, set just 3 months earlier in October 2025, was about 9.51 billion US dollars. Things are growing at an exponential rate, even the labor funds. And January didn't just break the record, it broke it by nearly a third. Now, let's take that in for a bit. Okay, these are the retirement savings of ordinary Taiwanese workers, and they just had, by a wide margin, the best single month in the fund's history. So that's the good news, and it's genuinely, historically good news. Here's where it gets a little complicated. The same week these numbers were released, the Minister of Economic Affairs, Gong Mingxin, here in Taiwan, was in the legislature explaining Taiwan's natural gas contingency plan. The short version is March is secured and April is going to have a daily meeting about it. Taiwan receives roughly 30 natural gas carriers every month. About 10 of them, that's a third, comes through the Strait of Hormuz. On March 1st, the United States and Israel launched a large-scale military strike on Iran, and by March 3rd, the Islamic Revolutionary Guard Corps had announced a full blockade of the strait. So by March 5th, only one oil tanker had passed through in 24 hours. The strait wasn't technically closed, but it was, for practical purposes, functionally closed, because without insurance, no commercial operator was going to run the route regardless. So the physical transit time from the Persian Gulf to Taiwan's roughly 14 days, which means the first disruption wave, the ships that were already in transit when the conflict started or that couldn't get underway after, starts hitting Taiwan around mid-March. So we have about 10 odd, maybe a few less days by the time you hear this podcast. And the minister's 3-stage contingency plan sounds orderly when you read it on paper. Stage 1, redirect long-term contracted cargoes from the U.S. and Australia, move the delivery dates earlier. Okay. Stage 2, coordinate shipment schedules with Japan and South Korea. Okay. Stage 3, buy on the spot market. But here's the problem with that. Japan and South Korea are executing the exact same plan. I mean, this is regional partners in the same area who are all vying for energy at exactly the same time, competing for the same cargoes. The minister acknowledged this directly. Coordinating with neighboring countries, he said, could be relatively difficult because nations are competing to purchase gas supplies. That's his words. And coal, the backup that's always theoretically available, can't actually be used until April because March still falls within Taiwan's air pollution control season. The minister called coal a last resort. He also said Taiwan would wait until April when restrictions are fewer before evaluating the option. So when we can't get oil tankers out of the Strait of Hormuz, Taiwan seems to have its hands tied behind its back in terms of the backup strategy. So the backup to the backup has a seasonal lock on it. What Taiwan does have going for it is some structural progress on the crude oil side, because the U.S. now supplies 28.3% of Taiwan's crude oil imports, up from nearly zero just a few years ago. And on February 10, state-run CPC Corp signed a roughly 25-year purchase agreement with a U.S.-based liquefied natural gas company, with deliveries beginning in June and annual purchases reaching up to 1.2 million metric tons starting next year. That's serious long-term commitment. The structural fix, it's good. It's real. It just starts in June. The acute crisis is happening now. The long-term solution and the immediate problem are on completely different timelines. And the gap between them is the 30 days the minister is managing one meeting at a time. And here's why it's worth stepping back, because this isn't a policy failure in any simple sense. It's a geometry problem. Over the past decade, Taiwan made a set of energy decisions that were each individually defensible. The nuclear phase-out. Taiwan reached its non-nuclear goal in 2025, responded to genuine public concern after Fukushima. the Japanese nuclear reactor meltdown, and the move toward natural gas responded to real air quality problems with coal. The slower than expected rollout of renewables reflected real engineering and geographic constraints. Each decision made sense in context. However, what they add up to now in combination is a country that has committed to powering 50% of its electricity generation with natural gas by 2030, and that gets a significant share of that gas from Qatar, which is currently under Iranian drone and missile attack. Taiwan's crude oil vulnerability has been partially addressed. The gas vulnerability hasn't, and gas is exactly where Taiwan is heading. The bridge fuel that was supposed to carry Taiwan from coal to renewables run through the most contested maritime checkpoints on Earth. And now TSMC is building another fab, or this has been years in the planning, but they announced it. The Tainan Science Park facility, announced for an environmental impact review this month, targets completion in 2028. That's on top of simultaneous builds in Hsinchu, Kaohsiung, and Taichung. Each of these fabs will run at full capacity for decades. They will consume enormous amount of electricity. The export orders that justified building them, for example, US $76.91 billion in January figure, the 102% ICT growth, and themselves powered by the energy infrastructure that's currently being negotiated 30 days at a time. Taiwan is building a machine that's the world's AI economy running on, and the fuel for that machine is arriving one ship at a time through a strait that is, at this moment, functionally blockaded. Now, here's where the story gets bigger than Taiwan. Every major Asian economy has a version of this problem, right? Japan, South Korea, the Philippines, between 80 and 90% of their imported crude transits through the Strait of Hormuz. Asian refineries this week were already running at 20 to 30% reduced capacity. The continent that manufactures most of the world's goods and consumes an increasing share of the world's energy is substantially dependent on a body of water that is currently under naval blockade. The U.S. has responded by deploying the Navy to escort oil tankers through the strait and by having the Development Finance Corporation, a U.S. government agency, step in to provide political risk insurance for commercial shipping that private insurers won't touch. In effect, the U.S. government is now backstopping global energy transit through the Persian Gulf. That's a significant commitment of resources. It's a commitment that has limits, however. And here's where the China dimension becomes impossible to ignore, because this week Beijing did something extraordinary. Chinese Foreign Minister Wang Yi called his Iranian counterpart and told him publicly that Iran needed to consider the concerns of neighboring countries when conducting its retaliatory strikes. China, Iran's largest oil consumer, asked its strategic partner to stop shooting at the energy infrastructure that China depends on. So think about what that reveals. China imports roughly 70% of its oil, a substantial portion of that transits through the Strait of Hormuz. Now that's on the leaving side. On the receiving end, in a scenario where China attempts any kind of military action in the Taiwan Straits, those same sea lanes become contested. And U.S.-led sanctions would require cooperation from the very Gulf state currently scrambling to stay out of the line of fire. Iran has been, for years, a structural strategic asset for Beijing, a source of discounted oil, a market for Chinese telecommunication equipment and surveillance technology, also a regional counterweight to U.S. influence. So U.S. military pressure on Iran, even if not explicitly directed at China, chips away at one of Beijing's key regional pillars, and it does something else. It tests in real time whether China can secure its own energy supply when the pressure is on. The answer this week is not comfortably. That's why the call. Beijing is calling for constraint from its own partner because the alternative is watching its energy imports get strangled. Analysts have argued that if Washington gets tied down managing prolonged Middle East instability, China gains time and space to consolidate leverage in the Indo-Pacific. That may be true, but the flip side is also true. An Iran that's destabilized, a Hormuz that's contested, and a Gulf that's in turmoil all create energy pressure on Beijing at exactly the moment it might want to be projecting strength elsewhere. For Taiwan, this cuts in two directions at once. A distracted United States is a reduced security guarantee, but a China that is watching its own energy supply wobble is also a China that may have less appetite for a new pressure campaign in the short term. Neither of these is clean. Both are real. Now, here's a framework worth carrying into all of this. Markets this week were pricing in risk. War risk. Gold fell 3.6% in a single session. During a war, U.S. bonds sell off as yields spike on inflation expectations. Bitcoin is down over 20% year to date, approaching bear market territory. Every traditional safe haven broke down simultaneously. But here's what the markets were actually trading. Not the war itself, but whether the war changes the long-term interest rate path. If oil prices stay elevated long enough to reignite structural inflation, long enough that central banks have to respond, that's a different economy than one that guaranteed Taiwan's January numbers. If the conflict stays contained enough that oil doesn't fundamentally reshape inflation expectations, then the stock sell-off aren't about geopolitics at all. They're about AI re-evaluation and market asking, as they have been for months now, when the return on all of this AI capex actually materialize. Taiwan and South Korea are right now the two standout performers in global equity markets. Taiwan's stock market is up 14.7% year to date. Korea's Kospi is up 29%, even after the recent sell-off. Both of those numbers reflected the same underlying story. The hardware rotation. The AI economy needs physical infrastructure. Taiwan and Korea make it. That fundamental rules doesn't change because there is a war in the Persian Gulf. The export orders confirmed it. The industrial production numbers confirm it. Even a labor fund returns confirm it. And here's the detail worth sitting with. The Bureau of Labor Fund posted its record January gains largely because 57% of its assets are invested overseas. The retirement savings of Taiwan semiconductor workers are growing fastest because the fund bet on the global AI hardware story rather than just domestic one. So the workers whose jobs are most exposed to this moment are the ones whose pensions are most positioned to benefit from it. The AI capex cycle is signal. Taiwan is right now the signal, but signal doesn't protect against supply chain fractures. And a 30-day energy horizon is a real constraint, regardless of what the export orders say. So let's go back to TSMC's Tainan fab, which will be 15.46 hectares, about 8 hectares of production floor, 14,000 direct jobs, 500 contractor positions. Environmental review is this month, construction starting later this year, completion 2028. By that time, Taiwan will have added major fabrication capacity in 4 cities simultaneously, in Hsinchu, Kaohsiung, Taichung, and Tainan. And this is not incremental expansion. This is the physical architecture of a bet that AI hardware demand is structural and sustained, and is here to say in simpler terms, that the world will keep needing more chips, faster chips, more power-hungry chips for years and decades to come. That bet is probably right. But it's a bet that carries an embedded assumption that the energy infrastructure required to run those fabs will be there when the time comes. That natural gas supply chains will have to stabilize. And the LNG deal in January, the delivery will have to be ramped up to scale. That the renewable build-out will have to be caught up enough to ease the pressure on gas, and that the geopolitical environment around the Strait of Hormuz, at least, will have settled into something predictable enough to plan around. None of these assumptions are guaranteed. What the minister's 3-stage contingency plan and his daily meetings in April actually reveal is that Taiwan's government understands this and is managing a gap between where the energy infrastructure needs to be there and where it is right now. The fabs are the long game, and the gas supply is the short game. And the short game has a 30-day clock. In a week, when every major power on Earth, the United States, China, Iran, the Gulf states, Japan, South Korea, they're simultaneously in the queue for the same fuel. We'll continue to watch how this unfolds. Thank you for listening to the show. I'm Joey Zhao. Tune in next week to find out more about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.